It's a Tuesday, Joey, and we're back after the deeper insights into infinite banking, because this, unlike our Thursday interview when we're normally going through an interview style where we're learning a new topic, today we're just taking and peeling back the onion on the infinite banking concept a little deeper. And today your eyes may water just a tad more than normal.
In fact, you may wonder, have Russ and Joey and all the coaches at Wealth Without Wall Street gone to the dark side?
Man, that's a cliffhanger, because today is different. It is one of those things where we're attacking a part of the process of infinite banking when you're taking loans against our insurance policies. And there's some areas that you've all expressed concern about, and we're going to talk about those in a second. But just before I do that, I would be remiss if we did not make sure that as you head into this episode, that you're equipped, knowing this is an expert conversation. This is not meant for a beginner. If you're just now starting your policies with infinite banking, I would maybe tell you, don't go listen to this one. This one right here may shake you up.
That's right. Russ and I have been at this for over 10 years, and we're constantly looking for ways to take what's already really good and look for efficiencies and to make it just a little bit better, just a little bit more simple. And that's what today's topic's all about.
Yeah, so if you've ever wondered, man, when I take loans against my insurance policy, I just wish I could get it maybe a handful of days quicker. And normally the processing time is 3 to 5 business days. What if I could have that same day?
Yeah, what if I could have actually a checkbook access? I mean, I've had that asked me a million times, and now we can actually say yes.
Well, and what if you could actually reduce the rate in which you're paying, because we're in a really low interest rate. And there's always this question of, man, should I use my insurance policy loan or should I go to the bank? And today the answer may be yes.
Are you intrigued yet? All right, now proceed with caution and let's belly up.
Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome into today's Round Table. I'm your host, Russ Morgan. I am sitting next to my partner in crime, Mr. Italian Stallion, Mr. Joey Murray. What's up, Joey?
Hey, man, I'm happy to be here.
Are you?
I'm excited. This is the chance we get to share a revolutionary idea.
Calling it a revolution?
No, not a revolution. It's a revolutionary idea.
Gotcha. All right. Across the table with us, we've got downtown. I put his nickname in front of his name, Mr. Ernie Brown.
All right. Fifth time's a charm, I guess.
Just let me try it one time. And the man between the bamboos, our resident pilot, Mr. Mark Cargucci. How are you, Mark?
Doing great, guys. Doing great between two bamboo, of course.
Well, if you're not able to watch this, it's because you're not in our inner circle and you need to be. You can do that by going to wealthwithoutwallstreet.com/inner circle, and you can participate and see the four of us sitting around these tables making fun of each other, and also participate in the discussion that's going to happen after this podcast, where we go deep into the subject matter and how you're actually going to do it. You're going to hear a lot about the what, but as we go into a deeper version within inside of our inner circle, you get to ask questions, and that's where you get the how. That's right. An important part, isn't it, Joey?
Yeah, and a lot of times the how includes being able to see something. Like, there's one thing to hear it, another thing to see it, and then to put it in action.
All right, well, let's talk about, we're talking about the infinite banking concept. Every Tuesday when this episode is released, it is just taking one more slice or peel back of the onion, if you will.
Yeah, you prefer the onion analogy.
I do.
So, I mean, I like artichokes. So I don't know, we can go to artichokes at one point or just stick with onions.
Let's stick with onions.
Okay.
I think onions is better. And we want to go deeper, right? That's the whole concept of this, is take one subject, go at an inch wide and a mile deep, if you possibly can. Now, a lot of that, as I said before, happens in the inner circle part. So we'll touch on that. But let's go into one of the things I think that is really important in the subject matters when we get into talking about taking out loans. Last week, you and Ernie did a great job of breaking down direct recognition versus non-direct recognition. And what I'm going to say is today's episode will make both of those things useless, irrelevant, won't even matter.
Well, it'll make them better, right? Because the direct and non-direct recognition has to do with the insurance policy.
Right.
The insurance policy that we're using for the infinite banking concept. So actually, I challenge that because I think it's actually going to make that better.
Man, I love it when somebody pushes back and comes up with a different idea. I like the idea too, Joey, of creating simplicity. Will today's episode talk about simplicity?
Oh, man. As you dive deep into the infinite banking concept, inevitably, you're adding policies, right? You're adding one on yourself, another one on yourself, your spouse, your children. It's not uncommon to have 5, 10, 15 or plus policies, and managing that can be somewhat difficult.
So, Mark, you and I were talking earlier this week, and you talked about sometimes the speed at which you can access money against your insurance policies is vital. You want to share a little bit about what you were telling me?
Yeah, absolutely. I had a last minute deal pop up. So I got in touch with the life insurance company to get a loan against my cash value. And unfortunately, even though it was quick by their standards, their turnaround time to get me the money and for me then to turn around and try and send it out, I missed that opportunity. That ship sailed before I could put my cargo on it.
Man. So when you say it was going to take how long for you to get the money in the policy loan?
I believe that one took, I think it was either 3 or 4 days for it to actually get through. And again, there was even a little bit more of a glitch because I had to email in my paperwork so that it could then be faxed over. So just, a few extra steps along the way, and I missed the bus.
Yeah, and sometimes that happens, right? When certain deals come by, we have weeks, if not months, to prepare for them. But there's some where it sounds like in your situation, you had days, and that's why I'm so excited to kind of talk about this idea today of when we're becoming our own banker. The whole purpose of that is to get our money into our control, and when we control the money, now we get to make rules, we get to make decisions and open up opportunities. Now, today's subject matter, though, Joey, may ruffle some feathers because we're actually talking about dealing with the bank.
Yeah, I kind of, I'm glad that Nelson's not listening, to be honest with you.
He's listening.
I mean, he's not present, I should say. He's not present because he would tell you anybody that's doing business with the bank is part of the problem.
Yeah.
Now, in the same sense, we are trying to make things simpler. We're trying to take advantage. We're trying to make the performance of our policies at the max potential, and we're trying to increase speed. Not to mention, in some cases, even lower the cost of borrowing.
Yeah.
And so I think for all those reasons, that's why we need to talk about this.
All right. So what are we talking about, Ernie? What is today's subject matter?
Yeah, well, we get to talk about taking our insurance policies, pulling them all together, taking total value, and using that as collateral for a line of credit from a bank provider.
A line of credit against our insurance policy. So that is a really interesting idea. It's something that Joey and I had positioned to us several years back. And at the time, we weren't ready. We said, no, I don't think this is for us. But as the environment has continued to change, as interest rates in which insurance companies can put their money to work has come down, at the speed at which opportunities are coming to us, because just like you said, Mark, I mean, we're constantly, I think it has to do with our mindset, but we're constantly being inundated with opportunities. And if you're listening to this and you're like, I don't have deal flow, then I'm just going to say you haven't focused on it. Because when you put your mind to something, you're going to start seeing deals. They're going to start coming at you at 100 miles an hour, and your job is going to say no, to say no. And what we have found is that the simpler we can make this, the ease at which we can transact business and use our cash values, and as Ernie was saying earlier, making sure that they're compounding, it's important. And we found an option that is not for everybody. So I'm not going to tell you that if you have life insurance policies that you need to go do this. I'm just going to tell you about it. I think it's important to know that it exists.
Yeah. So just if we're breaking this down at the very baseline, what was attractive to me as we've been talking about this is, number one, I'm dealing across 4 different insurance companies as it relates to all the different policies that I have. And so when you start thinking about just the mental gymnastics that go through, like, hey, I need $30,000. Well, I know I've got this one policy over here that has at least that much cash in it, but wait a minute, what if I pulled it from these 3 policies over here? Now I'm trying to remember which ones I have to pull them all up. I have to go through. And then when it comes time to pay them back, which ones do I pay back first? We talked about last week, like some of them are non-direct, some of them are direct. I might use the non-direct to pay off a direct loan. Anyway, it can get confusing, right? It's a lot. I have a whole spreadsheet that I'm trying to keep up with all this. And just the ease of having one location, especially as it relates to income equals premium. We're going to talk about that in another one of these inner circle opportunities, roundtables. And this makes it super simple.
So if you've not understood through all the babble so far, what we're talking about is how can we take these cash values, set up a line of credit against them where we would actually have a checkbook in which we could use to deposit immediately into our accounts to immediately be able to take advantage of opportunities that come, and it not have to worry about does it come from 1 policy or 6 policies or 21 policies. And I think that is a benefit because those are things that do stand in our way. And for some of you've mentioned just the managing of it is maybe a little overwhelming. And that's the reason why we thought this topic would be important today. All right. So Ernie, when you're talking to somebody, because you've sat in the seat more recently than anyone else in the room, you know what it takes to take a policy loan. You know the paperwork that's required. Mm-hmm. And as Mark said, it takes 3 to 5 days. Has that ever been a challenge for someone?
Oh, yeah, absolutely. The challenge of correctly filling it out, which I'll say is just a small challenge.
Yeah.
The challenge of having the bank account set up to point it to is another challenge. But probably the biggest challenge is time and the time that it takes to process and get that deposited. I mean, the life insurance company is not a bank, so it's not their fault. They have standard processing times, and we actually like that we know what they're going to do and the rate that they're going to do it. But occasionally we've had emergencies pop up,
right? And
we've had opportunities come that people have wanted to take advantage of. That's just taking too much time. They've missed it.
Well, I just feel that, there's that pressurized moment every once in a while where there is an immediate need. And then that's the question. Well, what if I needed the money tomorrow? Could I access the money for my insurance policy? The answer is most likely not. We have seen some situations where people could get the loan in. We call a special favor in. They get a wire done. It is by far the exception, not the rule.
Right.
Your experience, Mark, is more like the rule. It's 3 to 5 days, which is fine. It's great.
Yeah, for most everything we do, that is a very acceptable time frame.
That's right.
It's not like we have to have immediate access, but if you could have, it's definitely a benefit.
So one of the things that when you guys were talking about this last week, we were talking about direct recognition loans. And Mark, I don't know if you got a chance to listen in on that episode, but they were breaking down the differences between how whenever you take a policy loan, there's a direct recognition company will recognize you have a loan. And if it's in a lower interest rate environment, maybe it improves the dividend. If it's in a higher interest rate environment, maybe it reduces the dividend. And we've always looked at that because I've owned a bunch of direct recognition policies over the years. And I've noticed, because the interest rates being charged actually are lower than what the policy's performance has been. And so those policies have had a little bit of a haircut on the dividend. And I've always wanted to find better ways in order to keep those policies performing, but not at the expense of not borrowing the money to do deals that make more money, right? I don't want to major in the minors. And I was exposed to this example of, did you know that you could actually get access to your money same day? Did you know that your money can be working the whole time and not be affected from the direct recognition of the company if you are working with a direct recognition company? And all of those things piqued my interest. And so we went through a process of setting up this line of credit. And I will say, Joey, it wasn't easy, though. There was a lot of due diligence you and I had to do in order to find out which company would be a good fit.
Yeah, we interviewed at least 3 or 4 different companies, and they all had their own little take on this. It wasn't just like a straightforward way that everybody operated the same way. Some of them have limitations on what companies they will allow for you to collateralize. I'll mess up that all day today. Some of them had limits on how much of the cash value you can access and how quickly. Some of them, you had to have a signature from someone at their bank in order for you to take the loan, which just seemed like an unnecessary step in the process. So yeah, it was an education for sure.
Well, and as far as they also limited how much you could pay back, right? How frequently you could access the money, how many times you might be able to increase your credit line, because that, as we're talking about, setting up a credit line, just really kind of going back to what are we talking about? Imagine that you got your 2 whole life policies and they have $25,000 in one of them in cash value and $125,000 in the other, right? And so you have $155,000 or $150,000 of cash value. If you went out and set up a line of credit against these, so now you have your policies would have 0 loans against them, and you have this line of credit out here that you can write checks from. And so now, whenever you want to do a deal, you just write yourself a check and put it in your account. Well, now you have a balance against it. Now, one of the questions that's going to come up, Joey, really quickly is, but the reason I love a policy loan is I have no obligation to pay it back. So let's talk a little bit about what are the obligations to paying back this line of credit.
Yeah, so in particular, that also was something that varied amongst the different companies we interviewed. Some of them required interest payments every single month. Some of them required quarterly repayments of the interest. There definitely is not the same flexibility factor that you get with an insurance company directly when you're dealing with a bank, obviously, because you have now that person who's trying to make a profit by offering you this service. The gentleman that we're going to interview in our inner circle, his company or his bank offers a quarterly interest payment, and it's auto deducted every quarter as your balance moves up or down.
Is that principal and interest or what?
Just interest.
Okay, so that's exactly what's happening, Ernie, in our insurance policies, right? So for those who have never taken a policy loan, they might not even know how interest affects their policy or how it grows. Would you like to speak to that at all?
Yeah, so everything that was just from a quarterly basis, it's done on an annual basis.
Yeah.
And so when you take policy loan for an insurance company, we accrue daily simple interest, which means 2 things. In the negative, you have a daily outstanding balance, and interest accrues daily at the policy loan balance over 365 is your daily rate, and accrues daily at the policy anniversary. You get a bill for the annual interest. On the positive, every loan repayment you make to the insurance company by your choosing, there's no requirement to do that at any point or at any frequency, that lowers your daily rate, which is on the positive side, a 100% principal repayment, which means you have access to that portion of your cash value again.
Yeah.
Which, by the way, we need to do a whole roundtable just on this subject, because I think that there's a lot to be learned and understood about interest as it relates to policy loans versus even traditional loans.
So, Mark, you and I have had conversations about borrowing money against our insurance policies to go do investments, and the taxability or the potential for tax write-off of that loan interest, correct?
Correct.
Now, under your understanding, and you're not a tax professional, but I know we've interviewed a couple on our show. We're going to have 3 of them next week, by the way. We're going to be actually interviewing 3 different CPAs, and this is going to be a subject matter that's going to come up, so I don't want to steal a ton of its thunder. But what was your understanding of being able to write off insurance interest against policy loans for investments?
It's doable, it's legal, but it requires paperwork.
Yeah, it does.
And just like Joey mentioned it earlier, well, I got money out from this policy A, money out from policy B, money from policy C, and I had to pull from all 3 to make a singular loan value that I needed for, say, an investment. Now I've got to keep track of all those little pieces of the puzzle, where what we're now getting ready to dive into is, what if you could put that puzzle together and you're just pulling out of one pot.
Yeah. When you're talking about puzzles, so you went to our lake house not too long ago, and you remember that puzzle that was on the coffee table? This was the
Is that thing still there?
This was the puzzle from hell. Like, we had a girl who lived with us for about 9 months, and as a present or payback, I don't know which one it was, she gave us a puzzle with little bitty pictures inside the pieces. And they were not unique, by the way. There was multiple little pictures that looked just like that across this 1,000 piece puzzle.
I was going to guess 1 million piece. That's what it looked like to me.
It might as well have been. It took all of COVID and then some. And since COVID is still going, that's what I mean. It's infinite. It's the infinite puzzle. Well, but it is, when you're trying to put together the pieces to something, you would rather have a simpler option. And again, all of the things that we're saying is that you know how much we love infinite banking. You know how much we love putting cash in these whole life policies. And when I can make any step of that even better, more efficient, it just gets me excited. And that's what I feel like today is. Now, let's press the brakes a little bit. So we're talking about all the things that we like about it, right? I do want to really quickly, because we're going to jump into the how. You know, we're going to get into the recipe here in a second for those who are part of our inner circle. If you're not a part of the inner circle, you can join by going to wealthwithoutwallstreet.com/inner circle, and you can hear the rest of this interview that's going to happen. But let's talk about some of the cons here. We have sort of brought them up, but if it's all right, I would like to go around. I'll start with you, Mark. Just mention one con, as you know, as it relates to this strategy of setting up a line of credit and using the insurance policy as the collateral versus just doing policy loans. What would be one con that you would say?
One con for me would be the recognition of my cash value. If I have more than 1 or 2 policies, depending on when the institution is going to recognize that cash value, that's when I could have a problem.
Explain that a little bit further. I know exactly what you're saying, but I'm not certain everybody would.
All right. Say I've got 100,000 in cash value and my premium is due.
Yep.
I'm going to make that premium payment, or premium is going to go in, and now I'm going to have recognized increased cash value.
Yes.
Well, depending on who you work with, how this plays out, there are going to, when is that going to be recognized? How do I recognize it? How many times? What if I've got 3, 4, 5, or Russ, multiples?
You're saying at what point during the year will that line show the increase that was credited to your policy?
Yeah. So one of the cons is that whenever we pay premiums, we've got to go back to the bank and get our line increased. That's definitely, it requires effort, right? Just like anything, it's going to require us to do it. It won't automatically happen. I agree that is a con, and we need to keep that in mind. Ernie, what would you say would be another con?
Maybe in the same arena, you guys said you did a good bit of due diligence, kind of seeking out a provider that would do this in a way that would make sense for you, but also just watching you guys get everything together it took to get that set up. That was a one-time deal, but on the vein of increasing the credit line, in a sense, you're going to have to keep doing that. Not only do you have to make the premium payment to the insurance company, but you've also got to provide the paperwork to increase the credit line.
Which, when you say paperwork, explain what you're talking about. I think that's valuable for people to understand.
Yeah, for each of your insurance policies that you have, as you increase the overall access to cash value by making premium payments, you've got to provide a statement from each insurance company for each policy to provide to the bank to increase that line.
Right. No doubt. All right, Joey, what would be a con that you would throw in the mix?
I would say that the interest that you're paying on this can vary, right? Mm-hmm. And right now, it's actually below what you would pay to the insurance company directly.
And when you say it's below, so every policy I have except one is being charged right now at 5%, and it's at a floor. I'm stuck at 5. I can't go any lower. What is the rate at which people can borrow money from this?
Yeah, so right now, currently, it's like 3.95.
That's right.
So obviously, there's a benefit today, but rates could rise, and we always have the benefit to be able to decollateralize this if we want to and go back to the insurance company.
Well, I know that's a pot we can spin. I'm going to stay on the con, but what is the rate based off of?
That's a good question.
Good night. There's a reason I'm the details in this relationship.
I don't
It shows
remember.
in our outfits. So the rate is based on prime.
I was going to guess prime, but I couldn't
Don't
remember.
guess, you know.
Okay. All right. There you
It's
go.
based on prime, and depending on how big your balance is, it could be prime, it could be prime minus a quarter or prime minus a half. And when we talk to the guy, because of how many people may end up coming to him, I'm gonna see if we can get it prime minus one. You know who I'm talking about.
Hint.
You know who's listening. I'm not gonna say your name just yet, but you know. All right. So I would say that's definitely a potential con. The one thing that I would say is when all of this is happening, right? You know, our focus is how do we simplify it, and we're going to go into that right now, where we are going to sit down with our special guest. We're going to break this out specifically. We're going to tell everybody who's in the inner circle the company that he works with. We'll go through maybe some of the other companies that we vetted. Won't necessarily say their names, but talk about some of the things that we didn't like about them and why we chose personally to work with this guy. So if this is something that you're interested in, you have whole life policies, you've always wondered, well, I do have one of those companies that's direct recognition, and I would prefer not to have a haircut on my dividend. And, you know, obviously it's not the end of the day if I do, but I would not, you know, I'd like to maybe have access to my money at a quicker pace than 3 to 5 days. Anything that you can do to enhance this is making it better, then get in the inner circle. Listen to what we're talking about. We're going to give all this detail and let him be a resource to you as he is a resource to us. But thank you for listening. Next week, you'll get to hear from us as we talk about how this plays out in the tax world. Because in our inner circle, we're going to be interviewing 3 CPAs. So our subject matter is going to talk a little bit about how this is impacted in taxes, but also how our CPAs think about this, because I think that's important. Our CPAs think very analytically and numbers related, and we want to break this out so that way they can, you can talk to your CPA about it and understand how they're thinking about it as well. So thank you so much for joining us as we now jump into our inner circle.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.